Bootstrap Finance, The Art of Startups by Amar Bhide, professor at Columbia University in New York. Entrepreneurship is more celebrated, studied, and desirable than ever. Business school students flock to courses in entrepreneurship. Managers, fearful of losing their step on the corporate ladder, yearn to step off on their own. Policymakers pin their hopes for job creation and economic growth on startups rather than on once preeminent corporate giants. Belief in a big money model of entrepreneurship often accompanies this enthusiasm. Books and courses on new ventures emphasize fundraising, how to approach investors, negotiate deals, and design optimal capital structures. The media focuses on companies like Immunologic, which raised over $20 million in venture capital years before it expected to ship any products. Executives turned entrepreneurs try to raise millions from venture capitalists before they have sold a dime's worth of goods to customers. Lawmakers who favor entrepreneurship focus on tax incentives for venture capital and loan guarantees for startups. This big money model has little in common with the traditional low-budget startup. Raising big money requires careful market research, well-thought-out business plans, top-notch founding teams, sagacious boards, quarterly performance reviews, and devilishly complex financial structures. It is an environment in which analytical but toned-down professionals can make a seamless transition from the corporate world to the world of entrepreneurship. It is not the real world of the entrepreneur. Without question, some startups powered by other people's money have rocketed to success. Mitch Kapor raised nearly $5 million for venture capitalists in 1982, enabling Lotus to launch 123 with the software industry's first serious advertising campaign. Significant initial capital is indeed a must in industries such as biotech or supercomputers, where tens of millions of dollars have to be spent in R&D before any revenue is recognized. But the fact is that the odds against big money are daunting. In 1987, a banner year, venture capitalists financed a grand total of 1,729 companies, of which 112 were seed financings and 232 were startups. In that same year, 631,000 new business incorporations were recorded. Does this disparity mean that the United States needs more tax breaks, aggressive investors, and financially sophisticated entrepreneurs to channel VCs to more startup companies? Not at all. Over the past 2 years, my associates and I interviewed the founders of 100 companies on the 1989 Inc. 500 list of the fastest-growing private companies in the United States. The companies, Software 2000, Simplex Communications, Gamma Link, and Modular Instruments, to name but just a few, are not household names, but they are the mainstay of the entrepreneurial revolution that politicians want to sustain and that so many people, managers, and business students alike hanker to join. These interviews attest to the value of bootstrap finance, launching ventures with modest personal funds. From this perspective, Ross Perot, who started EDS with $1,000 and turned it into a multi-billion-dollar enterprise and a presidential campaign, remains the rule, not the exception. More than 80% of these companies were financed through the founders' personal savings, credit cards, second mortgages, and in one case, a $50 check that bounced. The median startup capital was about $10,000. Furthermore, fewer than one-fifth of the bootstrappers had raised equity for follow-on financing in the 5 or more years that they had been in business. They relied on debt or retained earnings to grow. What then is the problem? To quote Michael Lutz, CEO of Gamma Link, a high-flying Silicon Valley venture that provides PC to fax communication services, quote, raising money has become a disease. Entrepreneurs are wasting lots of brain power scheming to raise money, unquote. Professionals with MBAs and corporate experience are attempting to strike out on their own as never before. Michael Lutz, for example, is a physicist and Stanford MBA who worked at Hughes Aircraft and Raychem for 15 years before he joined up with a Silicon Valley guru to launch a new venture. Unlike the scrappy dropouts and malcontents of yore, however, these new entrepreneurs are unwilling to pursue business opportunities without raising big money first. Following textbook formulas for snaring investors, they attempt to recruit experienced teams. They write business plans with crisp executive summaries describing their proprietary edge. If venture capitalists are unresponsive, they network with venture angels. Even today, they have heard there is more
Sample complete. Ready to continue?